We're committed to being the industry benchmark in service excellence, innovation, and client experience, supporting a unique and diverse ecosystem. Looking ahead, we see enormous potential in digital assets. They bring opportunities to unlock new sources of collateral, enhance accessibility, reduce operational friction, and bring greater certainty and transparency to the market. We're actively exploring how tokenized assets and DLT-based solutions can complement traditional models and create more efficient, resilient infrastructure for the future. We're excited to bring the expertise that we've built in collateral management into this next chapter of market evolution.
Hey, Yamini, you should see the collateral in your wallet now.
Thanks, Jan. The power of the immutable record provided us completely transparent information, which meant our risk teams were able to make immediate decisions. Also, we had immediate access to defaulted collateral so that we can now onward pledge the assets and manage our capital with more certainty on these tricky days. Chris, can I go home now?
Baby, baby, baby.
Christopher.
Oh, Bieber. Home, Yarly. Margin Call is your home. Just stick around a little longer because you're doing such a fantastic job guiding us through this little storm. Well, I have to be honest, that was all a bit dicey, wasn't it? Not sure I would have invited you guys in if I'd known this was coming. But on the flip side, what a treat to see our app chain perform within a real-life stress environment. So what did we learn? Number one, resilience. Maximize resilience. Resilience is the major takeaway here. At Margin Call, we see liquidity and operational resilience, and both stood firm today. Our liquidity resilience was protected via real-time inventory combined with instant tokenization and mobilization of digital money market funds. As gilts crashed, both Margin Call and our counterparties quickly reverted to alternative assets to stay solvent. Operational resilience was also robust. You see the automation of key processes such as eligibility amendments, token conversion, and asset settlement. This ensured that we met high volumes and sizes of margin calls to avoid any default events being called on us. Number two was closeout speed. Now, in the unfortunate event that a trading party does default, as we saw, we need transparency in our closeout obligations and acceleration in the processing. Via the digital app chain, we tick both boxes. Now, as the market transitions to the digital world, we will all have access to the highest levels of resilience that you've seen today. As such, event default should become even less common, a major industry win. So even I'm starting to fade. This is a far more dramatic day than I imagined. But for our last stop, let's fly across to New York head office to see how the guys are coping with the fallout. I'll see you shortly after a few hours sleep in the front coach, of course. Ta-ra.
Our final scenario takes us to New York, where the aftershock of London markets continue to unsettle Margin Call. In our current state, Margin Call would typically need to borrow against its credit line or settle overnight repo to raise cash.
Digital cash allows participants to settle intraday repo with near instantaneous settlement, removing delays associated with traditional bank processing times. This enables the financing of digital assets and crypto with any digital currency, providing further liquidity and optimization benefits.
And as more financing obligations move to clearing to support risk reduction, optimizing margin across CCPs becomes more critical to firms. Margin Call is currently over-collateralized at FICC, but has a deficit at NSCC. Currently, it is not possible to transfer assets directly from FICC to NSCC.